Okay, so these are the initial questions that we'll go over, but first we're going to go and just look at a trade, okay? So I'm going to go and pull up earlier this morning, and we're actually going to look at the Russell. Okay, so we're going to start here. Here we are at the completion of the initial balance in the Russell. This is what we would call an open auction in range, and a couple things that are interesting to me, especially in the Russell. And I'm also pulling up the Russell because sometimes it's good to look at a product that you're not familiar with. Okay, so let's say here was the overnight high, here was the overnight low. I mean, this we effectively went from the lows of the week to the highs of the week overnight, and then here we are opening inside of yesterday's range. We're also looking at being right here at value for the week and 5 days. So if that's a new concept, in terms of like looking at composite structures. So one of the things that we always talk about and lean on is this notion that what we're looking to do is within the context of where we are. But it's really challenging because I don't find often that there's clear guidance on what context is. And so context for us is to look at it starts with the relationship of price to value over multiple time frames. So let's just start with looking at a 2-hour time frame here. So here's the Russell. Here's the most traded price for. Well, it was working, and now it's not. Okay, here we go. Yeah. Well, why are we not working here? Huh. There we go. Most traded price for last 5 days, last 20 and 90. What does that mean? It means that Russell's really kind of in a range. It doesn't have a lot of direction to it. When a market is in that type of orientation where you kind of stacked all of these references of value on top of each other, you can see moves, but they unless you can start accepting outside of those prices, most likely they're going to fail. And that's exactly what we saw early at the open. Is we had traded above new weekly highs, but now we're back inside range, and we have an open auction inside range. There's 5 different open types that you look at. How an auction starts is how it often ends, and we're just at a lot of references of value. What does that mean? It means we're waiting to see who's going to tip their hat. It is OPEX. It's triple witching OPEX. So good to be a pretty volatile day. Also noting that there have been a lot of overnight trade, like references that are not touched that are likely going to get cleaned up at some point. And so now we're just we got to kind of wait and see how this is going to play out. So let's play this forward. We'll start this at kind of 5x speed until we get a breach of the IB one way or the other, and then we'll kind of talk about the trade. Okay. So here we are in C period, still right in the middle, nothing to. And by the way, this is the time frame that I'm looking at, most of the time before I ever think about executing. Okay, so I'm just we're at the middle of the month. This is literally the middle of the month. We're at monthly VWAP, weekly VWAP, the 5-day SMA. There's a whole lot of references around here, which means, I really want this thing to kind of tip its hat one way or the other, and then I'll make a decision. Now, we do have, one of the early things, notice that we've had some selling imbalances overnight, and we have what's called selling excess in A period. So we attempted higher and have rejected lower. If we make a lower low in C period, that would further tap it, and then if we get below that weekly VWAP, that's where we're likely to kind of fall out of bed a little bit. So I don't need to front run any of that stuff. let the market show you. Okay. So at this point, a lot of outcomes can happen. We do have a narrow initial balance. So one of the things that I look at is how wide is that first hour. In this case, relative to itself, it's pretty narrow. So, very likely we'll get good excursion if we break one way or the other. And we also have an untested high, overnight high, and overnight low. That's a really key stat. In about 98% of all instances over a 5-year rolling period, we will test either the overnight high or the overnight low during the RTH session. Okay, so looks like we're getting some more selling imbalance in here. So let's go down to 1x. And now I keep this time frame in view all the time just to keep me grounded. I was having a conversation with a wonderful person last night who, like, she's like, I don't look at more than a 2-minute time frame. And I need to know a larger time frame because the markets, like, significant moves are driven by another time frame trader who doesn't care about a 2-minute time frame. Okay, they're thinking much larger than that. So start there as we start to see things happen in the structure. So things that are going in my head, we haven't extended the IB yet, but I'm looking at that and going, okay, I know I've got overnight stat that's out there. If I get below weekly VWAP, there's things to clean up. There's overnight inventory down here around 2120. There's also some GEX levels down there. So that's a reasonable target that if I push out, I'm going to extend and get into this area. So that's kind of, if I enter this on an initial balance, go with short, that's what I'm looking to do. Okay. So let's start playing this back and let's do this like we want to. All right. Let's rock and roll. Okay, so we have IB low breach here. So let's pause and talk about stop placement real quick. Okay, so on an IB go with short, so this is a playbook trade for me. Every playbook trade has a driving input, meaning there's a singular condition that's present that suggests, hey, I want to be in this trade. Okay. In this case, it's that we've established the initial balance, which we have, and we've extended it. And specifically, it's a narrow initial balance where there is lots of potential range to be seen outside of the initial balance. So, a great question to ask yourself is anytime you see the initial balance extended, the question is, well, how likely is it for me to get good excursion beyond that? Like the wider the initial balance is, less likely to get excursion. The narrower it is, the more likely. Now, does that mean it's always going to do that? No, but in the stacking probabilities in your favor, a way that you can stack probability in your favor is to look at and ask the question of, okay, I breached the IB. That's now tipped the scales to show me who's got some control, which is going to be sellers in this case. I always want to align with the operating participant who is the most in control. Okay. Now, in entering this trade, what's the target for me? So first is 1.5, the initial balance. That's statistically shown to be a good excursion. It's very reasonable. You can see that's nowhere near the overnight low or high. So this is like target one. This is the Euro IB range. So, and you can see that there's been some buying imbalance down there. So if I come down here, I could likely come and find some buyers that rotate me back up inside of this because I am hitting some composite references. So this is the area that I'm looking to target and exit first. And then we'll see if we can accept outside of that and continue to press. And what should happen is that once outside the initial balance, you know, we may wiggle back inside the IB a little bit, but we need to stay outside of it. The longer that we are inside the initial balance, we run the risk that we could go back through. And when you have a neutral session, or I'm sorry, a narrow IB, if we don't get outside the IB and run, then you increase the probability that you could go neutral, right? Which would mean that we would go through here and push up. So every trade that I take, and if you know, some of you are familiar with these questions, but if you've not done this, every trade begins with 4 questions. So where's the destination or the target? So yes, the driving input is the extension of the IB, but where do I believe that extension will take me? That's first. And then what am I looking to risk relative to that? Okay, so I've entered at 32. I'm looking to get to 24. Right? What am I willing to risk? Well, I can see clearly here where there was some build out in volume on a 30-minute profile, but there was also some selling imbalance here. So there's strong sellers that have come in that have taken us outside the IB. That's fine if we want to wiggle back up in here, but I don't want to see trade back through those sellers. So that's my risk. And notice that my risk here and reward, the reward is asymmetric to the risk. And you know, if you've been around long enough, you'll hear people say, oh yeah, I want like a 3R or something or a 5R on a trade. But when you dig a little bit deeper, and this may be true for you, is you'll find, well, that's just what I want to get out of it. But it's somewhat arbitrary how you're coming up with that number. You just know, hey, that if I hold for things that are more reward than risk, I don't have to be perfect. I can still have an equity curve that goes that way. But the market doesn't really care about your 5R or your 3R. The market does care about structural places where we've seen participants step in. So, you know, you have to kind of like build it within that to get a more robust. So that can get a little challenging. It's clunky when you're first trying to do it, but eventually, if you figure it out, okay. So let's see how this goes. All right, and we'll speed it up again now. Now, once you're in a position, you know, first question is target. Second question is what would I risk for that target? Third is what should happen. Fourth is what shouldn't happen. So what should happen? If we're going to, you know, have excursion towards this destination, I want to see more aggressive selling in that direction. I want to see us be able to hold outside the initial balance. I want to be able to see us build acceptance outside of the initial balance. So, you know, there's a time aspect, there's a participation aspect. All of that should be in play, you know, for this thing to work the way that I want it to work. And so far, I am seeing some, you know, more sellers. They're fighting around weekly VWAP. That not unusual, but you know, eventually they could tip the scales, and then we could rock and roll. So we'll see if they are in fact able to do that. What do you mean by blah, blah, blah? Okay, continuing to see imbalance to the sell side. That's great. We've got time. Now I'm not moving my hard stop just yet. But I do know like what shouldn't happen at this point as we're pushing outside of that IB. We should not get quickly back inside that initial balance. Okay. Notice on this 30-minute profile how like there was some acceptance here, kind of, you know, 2130, 2135. And we are getting down here to where we want to take some off. So we can see little, pullbacks to try to accept and build out the profile. So this is when we talk about acceptance. There's some acceptance here. There's not acceptance down here yet. Okay. We're kind of, back at where those sellers showed up earlier. And coming down here to the 20-day VPOC, which should slow the auction, which is a great magnet. It's a great target. We're at that 1.5 VIB, so statistically that's there. And we're going to go ahead and take off too, because you can see a little bit of the stacking. Yep. Just some stacking of some buyers down here. All right, so now we've got two off. We've got a runner. Now where do we move that runner stop? Okay, we're going to move it back inside the initial balance. Now, not right at the IB, but I'm going to move it here where there's other sellers of note. Okay, so because we could trade up into this area. We could trade up in that area and then rotate down and build out. Part of the job is imagining what could this profile look like by the end of the session. Okay, but we got to 1.5. We got the meat of this. Let's take some risk off, and now we've got a runner. Trades paid for. If we fall out of bed and go take out the lows, great. Okay, that's an IB go with. Now, if this becomes a trend day, we could look for trend continuation, which that did actually signal later. I wasn't in that one, but this was, a kind of a clear idea that I saw. Okay. All right. When I say sell imbalance, how are you quantifying that? Maybe had you missed that. So it's a 200, looking at bid and ask, okay? And we're looking at a spot where we're seeing 200% one way or the other. And, I like visual reminders so I can see it on both of these time frames, but these prices are all spots where there was a 200% selling imbalance. So, what does that mean? It means like, okay, on the bid and the ask, if I've got, 20 contracts somebody wants to throw down, okay? But let's say that there's only 5 offered, but somebody throws 20 down. Well, that's more than 200% on that one. It's gonna take the next tick down. It's gonna absorb that. We got an imbalance, and it's showing us impulsive participants who are aligned in the direction that we want to go. Now, do they have the same destination in mind? Who knows? But if you're looking for better excursion when you enter, or you're looking for that classic question of, should I stay with this or should I go? When should I get out? So that it doesn't go against me. What should I defend? Defend strength. One of the ways that we look at strength is where significant participants came in and there was an imbalance in the order flow, one way or the other. That's something that's worth defending. Okay, and learning how to find where those points are. Great question. Okay. Okay. Next question. In ES, would your profiling tools have indicated the bearish move from 670 to 610 at 850 Central? So that would have been right after the open, yeah. Let's turn this off and let's go back to real time. at 750. So we did have good selling excess in the ES today. Now, I rarely trade the ES. I do look at the ES all the time. I think if you're an equity, futures trader, you need to look at the ES. It is not often wide enough for me to entertain me when I can do the Russell or the NASDAQ. But, I mean, the ES is the bedrock of the equity space, right? The SPX complex is where the world hedges its risk. We did have selling excess. We did have an impulsive seller come in right here around 60.55. Would that have suggested that we would have gone to 60.10? I mean, that was not a playbook trade for me. So the ES did put in a pretty wide initial balance. So not. And we had already tested at 57. We'd already tested the prior day's point of control. I mean, I think potential directional open go with from 60.50 to like 60.40. But that would have been a more challenging trade because you're right back into the middle of a lot of inventory, and it's always challenging. Like the more references around there, like weekly VWAP, monthly VWAP. GEX prices, prior value, the more likely you're going to have participants fighting around those places. You're just not going to get clean auction out of it. So yeah, no, that wasn't in my dram. All right, sweet. Okay, still have an issue. Which profile is more important? The daily or the 5-day? Just today before noon, the daily profile had an LVN right before the 5-day had an HVN. This price was approaching that LVN on daily and high volume node. A couple taking an IB go with, or IB go pull back short. What product were you looking at? ES. Okay, so in the question of which is more relevant, this may be helpful for I hope this is helpful for a number of you. Whenever we come into the auction, we don't yet know how auction participants are going to handle value. We don't know where value resides for that day's auction. So this is a question for anybody who wants to answer. What is the first reference of value when I come in to a new session? So ES starts today. What's the price that's most relevant as you're beginning the auction? Yeah, absolutely. Prior value. Okay, so prior value, which you can see here, if I could draw on this, is here. So initially, whenever we start an auction, we're always referencing the prior value first. So if you're not thinking about the prior session when you're looking and expressing, I think you're missing a significant input. Now, as the session evolves, what are participants doing? Are they accepting that prior value as value again, or is there new information into the market that suggests that value resides somewhere else? And then we could see that happen. I mean, we can look today and say, well, how would we read today? We would suggest that value ultimately developed lower after a couple sessions where we were developing composite value around here. So first reference of value is yesterday's most traded price. Beyond that, it is the most traded price of the last 5 days, like on a rolling 5-day basis. Why 5 days? Like, what's magical about 5 days? Because there are option cycles that expire on a weekly basis. Okay, and then why a 20-day profile? Because there's options that expire on a 30-day basis. Why 90? Because there's quarterly. You just kind of have to cascade up through those time frames. For most of us that are looking for ideas within a intraday time frame, contextually, all we really need is where's price relative to a 5-day and a 20-day, and then where are we developing value relative to yesterday first. That kind of gives us an idea. Like, are we rejecting that value, trying to develop somewhere else, or going elsewhere? So, in the cascade of where we are, that's how you kind of rank those. Now, note, here's something I think that interesting, kind of looking at this clean like that, is that the most traded price in the ES here at 6064, most traded price of the prior day, real close to that. Notice how the auction opened and then rejected and created this selling excess. So it attempted above that composite reference and then traded back through that. You could make a case that this is a high volume node reversal, and that is a playbook trade, is where trade attempts past a composite reference and then trades back through that. You're going to defend against further excursion in that direction, and you're looking for the auction to explore in the other direction. So looking at it up here, I would say, yeah, there was a playbook opportunity early, and this is not a playbook opportunity that the driving input requires the initial balance to be established. It's a challenge. This was a challenging one because you're early in the session. You don't have a whole lot of information, and the more information that you have, the more confidence that you have in that position. But they rejected attempts away from and then ultimately established value somewhere else. So when we come in on Monday, 5-day will still likely be up here, or no, I'm sorry, the 5 days shifted as the auction progressed. So 5 days now here. And then most traded prices here. So all things being equal, unless we get above 60.50, we should see the ES trade lower tomorrow or on Monday. Okay, good question. Great. Let me get over to some of the questions that were submitted here. Rock Rose. So I think this is a great question. Like, how to stop overtrading has been failing funded accounts and start focusing on the process. So overtrading is like absolutely one of those experiences of traders that often can take a pretty good equity curve and then turn it into junk. And it's an impulse control. How do so it means that there's going to be a discipline around that. There's a couple practices that you can consider. One is, if you are tracking, like when you're taking an execution, I always go and say, well, is this a playbook trade? There's a great practice you can do. Is like anytime you could pause the market at any time and say, okay, is there a playbook trade here or not? What would have to happen for a playbook trade to show up? Like, what would have to happen? How would it have to evolve for that to be the case? Okay, if there's not, I don't trade. If I still click the button, the helpful practice is to be able to at least track that and say, hey, that was kind of an impulse trade, or I'm fear of missing out trade. But I've seen several traders who, if they were able to do that piece of just categorizing, hey, this was a playbook trade versus this was an impulse trade or FOMO trade, what they find is, oh my gosh, if I just took away the FOMO and impulse trades, my equity curve looks great. And it's like an aha moment that kind of cracks things open for them to this reinforce the practice of, I want to wait for a playbook trade. It's really tough when there's stuff blinking at you, right? It does things to our brains. Another way that I could suggest to remedy that would be, be mindful of what time frame you're looking at most. So often when I'm doing audits of traders' approaches, they're spending their time looking at really, really small time frames, and find a higher time frame to home base at, and then hide the smaller time frames from your view, only pulling them out when you're convinced that this is the play structurally I want to execute. Okay, and then I think that can certainly help. Quick note on the funding account thing that's happened in the industry the last number of years, and then there are some I think some commendable things about that. The fact that there's a way to practice in real time. There's a way to think about risk. They are tuned kind of like a casino to try to get you to keep trading, and they're kind of banking on the idea that you will not be able to out trade yourself. That's the enemy. And similarly to a casino, it's like the person who wins and they don't leave they don't leave the table. They come back and they end up giving it back, right? So those are just a couple ideas on how to come at that a little bit different way. Okay. Next question. Notice that wide IBs often form on directional opens and narrow IBs on more balanced ones. Seems to clash with the setup conditions for extension fade, which prefers a wide IB and a rotational day, and IBGW, which prefers a narrow IB and a directional day. So you're not misunderstanding the typical relationship, but there are contextual clues to this. So let me get a drawing, like a whiteboard up here, and we'll go through it. Yeah? Okay. So, when I need my drawing board to catch up here. I don't know why it's not. 1 second. Okay, so we should see a blank screen, yeah? I don't know why. Okay. Oh. But I'm not. Why am I not seeing? Okay, now I am. Great. Okay, just taking a second for it to catch up. So the initial balance, which is that first hour of trade. Okay, we have the range of the IB. 98% of all instances we're going to trade outside of that initial balance range, meaning that we're going to see price past one of these extremes. In about 70% of instances, we will only extend in one of them. So what's cool about that is that once I've extended in one direction, I'm not as likely to extend in the other direction. It's a great observation to carry forward. Okay. Now, not all initial balances are made alike. Some are wide and some are narrow. And and some are average. So, an average IB is we look at the average width of the initial balance over the last month. That would give us an average IB. And then if we look at a narrow IB, so that would be if we were 75% or less of that average initial balance over the last month. And a wide IB would be if we are showing 150 to 200% of the average initial balance. Okay. Why is this helpful and important? So if I think about, the first hour is where the highest amount of volume is poured into the market. We have market on open orders. Participants are establishing positions in that first hour. so like the first opinions are made in that first hour. After that first hour is all the follow-on behavior. That's, so we would say that the other time frame, or the trader is actually going to move a market. It's operating in that first hour, and it's the daytime frame trader that's kind of on their coattails. To the idea of that breach of the initial balance, because it's so probable that it's going to breach that IB, we always ask the question of like when it breaches. So on a breach, if you want to trade idea every day, this is an idea every day. So we have a breach, like, should I go with it or should I fade it? It's that simple. I break the IB. Should I go with it? Should I fade it? Now we articulate, the traders that have worked with us, they're looking at a number of playbook trades. So with around the IB, I think there's basically 3 playbook trades. So one is what we just covered with the Russell. It's an IB go with, meaning I breach the IB and I'm going to go with that. I believe it's going to like break it and run. Another one is an IB go with on a pullback. So what does that mean? Let's say I take out IB high. So that's shown me that the buyers are strong enough to get past that first hour's range. That's who's in control. So if I think about how I want to trade, I want to align myself with that participant. I could look for responsive activity back into the IB to be long. And it may be here at like the developing point of control, or it may be down here near the IB low, and I'm trading back to the middle, or I'm getting good favorable location on a pullback that then finally gets a push in this direction. Or there's an extension fade. Okay, so that is the should I fade that? And to try to help know when those might be in place, we look at the width of the IB. If it's a narrow IB, and if I'm pouring all of this into the first hour, the smaller that IB is, the more likely it is that there's a participant that's going to come after that first hour and push us with some good excursion. So if I see a narrow IB, I am really reticent at trying to like fade that. That's not, we would say, stacking probabilities in your favor, because we can't guarantee an outcome. We are all passive in terms of what the market offers us. We can only control us and how we show up. So then, I'm not gonna risk that. If I have a narrow IB, I'm looking for pushes outside of that IB, whether it's in a go with or in a pullback, and going in that direction of where it's been extended. If it's wide, if I've got a 200% IB, then I'm looking for opportunities to fade. And as the question came up, the question was, I see that we have wide ones that go into directional days, or it's a directional open that derives that. Yeah, because how you get a wide initial balance is that there was strong conviction that got that thing really wide. And then the question is there enough conviction to continue that or not? Okay. The driving input on an extension fade is that I've extended the IB, but that's just the first piece. The second piece is that I have to have price to value divergence. So what does that mean? That means that, hey, I got price up here. I got price up here, and I got value here. These are divergent from each other. So if I see price fail back into the initial balance, unable to move the point of control out of the initial balance, I'm increasing the probability that I'm going to go back to value. And this is, in fact, one of the questions that we think about all the time. Is value moving to price or price moving to value? So if we are not able to migrate value to price, then price is going to go back to value. So the divergence is one piece. The second is that I actually start seeing some failure in the price. I see traders that want to be too aggressive. They see a wide initial balance and like, okay, great, I'm going to fade that sucker. But there's nothing that says that there's counter strength yet. And there are times when, that directional push on the first hour goes into a directional day. And so it's the first input. You got to wait. You got to wait for confidence and a tell that it's going to go that other direction, which really leads me to talk about this curve. Okay, You're going to think that this is a profile on the side, but it's really not. This is the marketing adoption curve. Right? You guys would know this. So you have the innovators, and you have the early adopters, and then you have the early majority, and then you have the late majority, and then you have the laggards. Now, let's think about the auction, or like getting into a move, and like the first people that like jump on that move, they're the innovators, right? Well, I don't know if you've ever been somebody who's like tried to start a business or been around, people that are fairly entrepreneurial, that people really early. What's something that happens around that? They're early. They have some big wins. They're also most often wrong, and that's one of the things that they have to reconcile themselves with. Why are they most often wrong? Because they have the least amount of information. But if I follow this curve and I go, okay, well, like there's initial activity that's going to bring in kind of that next tranche, and that's going to be the early adopter. Okay, it's going to be on the heels. That's kind of like validating the innovator, right? That's now starting to show me some more information. So I always think that the best place to enter is not here. This is like trying to catch. I apologize. It's not trying to catch the turn. I'm really uninterested in catching the turn. I'd much rather be kind of in the chasm here. I've seen some of the early adopter, but look who all I'm ahead of. So specifically around a fade trade, if there's been strength that got us to a situation and you're looking to fade that, let's see some failure first. Let somebody else take those chips and prove that there's some failure and willingness to counter that first. You don't have to be first. That will build the confidence of, we are gonna rotate that. And as if I see that failure and that divergence of price to value is still there, I'm more excited about that opportunity than just the idea of we extended the IB and it was wide. Okay. Okay. Next question. All right, on Monday, and this is really slow. It's just not wanting to catch up. Okay, let's see. On Monday, we saw most of the volume build outside of the developing value area, which might suggest early acceptance, but the very next day we reverted back into the composite. Broadly, since I'm not swing trading but day trading, but personally lean toward fading through the scenario. Continuation trades in the direction of the presumed breakout. Okay, so let me think about this. I'm outside the development value area. Next day, we reverted back into the composite. Well, here's what I would say about, kind of where we are at the moment. We're in a market cycle. Now, there's lots of different types of cycles of markets and cycles that show up. There are time-bound cycles where we can see certain types of behavior. There are monetary market cycles, like you can be in a monetary market or a fiscal market, really from 2008 until 2021, we were in a monetary market, and we've been in a fiscal market since that. What does that mean? It means that you have a period where the Fed is actually behind and accommodative versus not accommodating. You have cycles when there's no influence of geopolitical things, and there are periods where there are. What was this week? This week is OPEX week. So we have triple witching OPEX. We've got VIX expiration on Wednesday. We have a short session. We have FOMC, which is, that's a rate decision. It's big, and there's so much to talk about rate decisions. So it's a higher likelihood that we will see attempted breakouts not succeed. in this type of environment. You know, when you have an accommodative market and you have no geopolitical conflict and everybody's aligned with the Fed, you can have like 10 trend days in a row, which we've had in prior summers. And could potentially happen. Like we're about to step into that period of the year where we see that kind of like slow drift. And, you know, if we don't see any breakage next week, I would say that that's going to be the program until we get to the fall, is we'll just kind of see the slow drift higher. But it's not so much a faction of like, hey, we had, you know, this day and then it failed. What mechanically was happening was that, well, actually, let me pull in a chart that would be a better explanation of this. Hold, please. Okay. Let's go here. Okay. So what is this? This is an inverted chart that looks at 1 day VIX versus 9 day VIX versus the VIX itself. Okay. Since November of 23, more than 60% of all option volume on a given day happens in options that expired that day. So, I mean, we're really looking at trying to measure positioning around that. So how people might have used the VIX itself 5-10 years ago, I think you use the VIX 1D in that same vein. But because you're having these expirations that happen like the next day and then the next day, you know, let's look at Monday, or, you know, what happened. So on Friday, we saw a pretty significant I don't know why that is having so much trouble. We saw a pretty significant move lower. Again, this is an inverse. So like I have this inverted because it just makes my brain work better. Basically, we had a spike in the VIX 1D on Friday, lower prices. Okay, but that is then gone. We come into Monday. You know, what are they doing? Yeah, they you know, start buying some more puts, but not as many. So, you know, we're getting some excursion higher to start, but then the next day we're under hedged and we're going to get ready to have FOMC. So people need to buy protection, and that's what we start to see a movement here in the 1D. So we are not seeing as much second day follow through as we used to see prior to the roll to participation in 0DT. Prior to like November 23, like if I saw a strong trend day, I could go home in that, like if it was a trend day higher, I would go home long, you know, or if it was a trend day lower, I'd go home short, and would expect with high certainty that we would see RTH, you know, like new extreme RTH prices in that direction the next day. I don't have that confidence anymore. And that's a function of how much participation is in 0DTE. So there has to be like this rebalance of inventory with market makers that kind of resets it. So instead of getting that follow through kind of like the next day, it's like the day after the next day, right? So like if you look at, you know, kind of how today ended, like there was a movement into puts as the day progressed, not like crazy bearish. So there could be a little bit of follow through on Monday, but if we don't see new participants come in like immediately on Monday or at the beginning of the Euro Open on Sunday or early Monday morning, look for the market to reverse back higher, at least on Monday. So the long way of answering that question, but it's a good question. Okay, gang, we've got like 5 minutes left. What else? I think I covered the submitted questions, so we got those. We'll do another one of these next week, so we'll send out the link to this form. So if you have a question that's like burning and want me to have a little bit more preparation around that, feel free to fill those out. And we'll try to have examples around that. Otherwise, if we wanted to... Am I looking closely at options depth or other platforms for 0 DTE flows? I mean, there are platforms that can track those. I'm a Spot Gamma fan. I like Brent and Matt, they're good guys. And that's really kind of all I need. I think you can kind of shortchange it with something like this by like looking at the relationship of, is the hedging happening in 1D or else? That's why I have the 9-day and the 30-day VIX here as well. So if we looked at into FOMC, we actually saw movement in longer duration than just the 1D stuff. And, they kind of held those positions through FOMC and like added to it with 1D stuff. So when you see a day where you've got like all of the durations going in one direction, that's pretty strong. And you don't have to look at, necessarily option flows around that. Certainly can. I mean, that is the tail wagging the dog for sure. That tells us where we go and can't go. So, great. Awesome. Well, gang, again, happy OPEX. I hope if you had positions that expired, they expired in your favor. And we'll be back next week. Send me additional questions. Give me some feedback on, if this was helpful or not. What you'd like to see. There's a library of old Q&As from years ago that the audio is not real great. The platforms have advanced a little bit, and so we're going to kind of slowly replace those with these sessions, and just have a library that's accessible for people to kind of work on figuring this stuff out, because it's a challenging endeavor, no doubt. It's made even more challenging, if you didn't have the opportunity to work in the industry, like on the institutional side of the business. Man, it's really tough to kind of suss stuff together, and so trying to help you out. I start scalping. Profit target, how do I start manually spending my future payout? Okay, so here, this is a great question. So the question is like, I'm scalping one in Q in a funded account and following rules. So I'd have a question about like, what do rules mean? Does rules mean it's a playbook trade? How many trades are you taking? Most likely you're taking a lot of trades if you're scalping. Okay. Please understand what that does to your brain. The activity is what is going to like pull you in more and more, and that can ultimately lead to it failing. There's an internal question of, do I really want to be successful at this? Like, what do I really want? Do I want the activity more than the outcome? It's something you have to kind of meditate on. And to that point, even doing a meditative practice can be helpful at building the skill, because it is this impulse thing. You're in an environment that's aligned against you, unfortunately. So when that happens, we have to be able to tap into capacity or cultivate capacity that we may not have to keep us, almost kind of like to keep ourselves from hurting ourselves. I mean, there's ways that you can do that by like locking out your platform. Most of these things have to be pre-thought. So it means it's part of your pre-thinking process, pre-execution process that primes the brain to allow you to access it. There's been pretty exhaustive study. Most of it you can see in John Coates' book. You can read some stuff from Denise Scholl, Behavioral Alpha, where once the brain commits to risk, it wants more of it. And then if you've had positive excursion, there's something called Hercules phenomenon that kind of comes in, where you just kind of think, you don't really cognitively think that or consciously think this, but you think you're kind of invincible, and then you just end up running yourself over. So all that to say, like, awareness is first, cultivating some practice around that as part of your practice. Like, is this my trade? Is this a playbook trade, or is this an activity thing? So stepping back and getting some awareness around that. I mean, if you're getting into funded accounts and that's working, like, you're getting past that threshold, so you're certainly identifying some great movement in the market or price action that you've been able to exploit. That's great. What's going to help that stick is some of these other pieces. So I wish you well.